Welcome back, and corporate conversations continue here on ET Now. Thanks for sticking by. Sanjay Sharma now, Managing Director, iFinance, joining us. The stock is up 90% since the month of March, 35% since mid-May. Seen a stupendous rally. Let's take a bit of a pause and try and understand as to what's playing out. Great having you here, Sanjay. Let me first start off by understanding growth. The understanding here is 17.5% growth for the month of May. Looks extremely strong. What do you think are factors which are holding up growth, especially at the margin where you really lend? You know, corporate not so much, but more on the MSME side of things. What's driving the growth?
Good morning, and thank you for having me on this platform.
Very good morning.
I think iFinance lends to the unorganized micro MSMEs, which are typically there in the hinterland of India, in tier 2, tier 3 cities. And therefore, it reflects the fortunes of these segments. Now, the interesting thing is that these segments don't get impacted by many of the industrial or organized industry plays like change in tariffs, or even to some extent the change in oil supply, etc. So they tend to be fairly robust, and we've seen that despite the war and the background, the businesses continue to do brisk business. They would sell their produce, which are manufacturing, trading, or service-related products, to a segment that is always needing these products. These are not discretionary products, so there's always a demand. It's inelastic demand. And I think we have this year found that businesses are continuing to grow, and there's a huge demand for our supply of micro MSME loans.
Sanjay, hi, morning. Give me a sense of the kind of risk management that you're putting in place, because you have exposed to MSMEs in tier 2 and tier 3 cities, and we have monsoon impact also coming in there with delayed monsoon, which impacts consumption and sales there. How are you managing that risk as well?
So we divide our lending into various industry types or clusters, and we don't concentrate on any single cluster. So it's not as if we are concentrated into agri-related sectors, etc. So that keeps a portfolio fairly stable. And on the effects of monsoon, I'm sure that there will be some effects to the segment, since people who purchase from them will find that inflation has an impact. But I think that since these businesses produce basic essentials, they will be probably better placed to pass on that to their customers. So the sense that I have is that the customers will not get strongly, our customers, which means the MSMEs, will not get strongly impacted. And at least in the first quarter, we've not seen any sort of indication of that. I think the monsoons are yet to arrive. And the good news is that we have enough grain stores. The wheat produce has already happened. It's the rice produce that might get partly impacted. So I think as time goes, we will continue to monitor and continue to see the diversification play out and help us in managing our risk.
Sanjay, I remember you talking about the fact that repeat loans to well-paying customers is a strategy, and you flagged it off as well very categorically. Tell me, what proportion of your FY27 disbursement growth is going to come in from from existing customers as opposed to new to iFinance customers?
Yeah, I think interestingly, most of our growth comes from new customers, and which is quite unusual because companies often rely only on their repeat customers. In our case, we disburse almost close to 40,000 loans in a single month, of which close to 30,000 loans come from fresh customers. So these are new customers that we are reaching out. The reason we are able to do that is because the segment that we are targeting had been excluded from financial inclusion. And this is a very large segment. It is almost estimated to be in the range of 60 million such customers. So there's always a demand. There are new customers coming in, and the old customers tend to stay with us because there's no one else who provides them that working capital loan of 1 lakh to 2 lakh rupees, which we do quite effectively.
You've guided for an AUM growth of 25 to 30% for FY27, right? Alongside a 3-year vision of 28 to 33% of a band in terms of CAGR. Given that your yield on advances, Sanjay, has already fallen from 24.4% to now thereabouts 22.25% over 3 years, are you growing into a more competitive but low yield tenure?
Actually, the reason the yields have fallen is because our mix has moved from hypothecation loans to more of mortgage loans in the last few years. In fact, today we have about 22% of our loans given as micro lab. And since there's property behind that, the rates tend to be lower. 3 years back, we used to have almost 98% of the loans given as hypothecation loans where the yields are higher. Our yields have not fallen on the product. So product interest rates are still the same. All that has happened is the change in mix. I think also this year after the IPO and we recently got a rating upgrade to A plus stable, we will see that our cost of borrowing will drop. Our estimate is that our cost of borrowing might drop by 40 to 50 basis points during this year. And I think that's why our net interest margins will stay stable as they were in the last year. We'll have the same net interest margin this year also.
Sanjay, I just wanted to dig a little deeper on the working capital loans that you give to MSMEs. Has the cost of these loans increased for them? Have you increased the rates for them over the last 1 or 2 quarters?
Actually, we have not. And despite the fact that COVID was a difficult year for us as a company, but it was also a difficult year for our customers. So I think we have continued to stay on with the same rates. And in the last 3 years, there's been no increase in rates. In fact, our repeat customers, whoever comes in for the repeat loan, normally is given a 1 or 2% lower interest rate from where they start. We continue to follow that policy. And with mortgage-based or micro-lab-based loans coming in, I think the rates have actually become quite attractive at 23 and 24%.
And what about your cost of borrowing? Has that been stable as well, or has it gone up?
Our cost of borrowing, interestingly, is falling because the inventory of borrowing that we have were at higher price point. So last year we had our average cost of borrowing at 10.8%. Today the incremental funds are coming at 10.2. So because of that replacement of old inventory of higher interest rate loans, we are finding that our borrowing rates are actually falling.
You're able to pass on the entire differential to your net interest margins because of that?
We are trying to, besides the fall in borrowing cost, we're also trying to work on efficiency this year. And we hope to shave off almost 100 basis points from our operating expense ratio. Last year it was 9.5. And we will we are targeting to make it in the 8.5, 8.75 range. Once these two things happen, we will certainly look at how much of this can be passed on to the customer, because we don't intend to deliver ROA post-tax of more than 4.5 or 5%. That is a reasonably good ROA for this business, and anything excess will be passed back to the customer.
Sanjay, just trying to get comfort with regard to what the impact of a possibly weak monsoon could be. Again, I'm probably trying to reiterate this, but would the impact be fully understood by Q2? Is currently the right juncture to kind of fully price in the impact? You're saying that there's very little to no impact. So should we just wait and watch? What should investors do and think?
I think the impact of rains on our portfolio as well as for any other business will be seen only in the third quarter, because second quarter is when the rains will come. And third quarter typically for businesses happens to be a very busy month, because this is the quarter where you have all the festivals, Diwali comes, Christmas comes, and the sale actually starts peaking. So you will know that how badly the rains are impacting the food supply or the inflation. But as I said, that from where I stand, it looks like while there will be shortfall in rains, but it may not have as strong an impact on inflation because we have adequate grain stores in the country.
Raised equity via IPO, as recent as February. Tell me how much of those funds have actually been utilized and what's the balance left?
Oh, yes, we raised about 710 crores in February as part of the IPO, which was a fresh money coming in. See, we disbursed close to about 450 crores of disbursement in a single month. So that 700 crore would have got deployed straight away in the last few months, but it gives us a higher net worth, which helps us leverage our borrowing. So when I take 700 crores of equity, it lets me add 3 times that in borrowing. So it actually, in effect, becomes 2,800 crores of funds available in the future. We have only used part of that, and we believe that we will not need further equity for the next 2.5 years, considering that we are growing at 30%, 25 to 30%.
Okay, Sanjay, great having you today on the show. Thank you so much for your time.
Thank you.